Okay guys, over the last few days we've been reconstructing some key accounts, and today we're going to look at what happens when there's a sale of asset. And again, we dealt with this in year 11 last year, but this year we're going to look at the revision or a little bit of a review of what happens when there's a sale of asset. So I'm going to use today the example. Let's say we've got a motor vehicle and we bought that motor vehicle 3 years ago at a cost of $20,000. Okay, so we've got that original cost, that's what we paid for it, and we've kept it for 3 years now, and we've got the accumulated depreciation of that vehicle of $9,000. Okay, so in other words, the vehicle has depreciated over that period of time. During this accounting period, we find that we've actually sold the motor vehicle for $13,000 cash. So if we look at those three pieces of information, what we want to do today is have a look at how we deal with that. All right, what's really important to remember is that last year we dealt with all of this by reconstructing an account called sale of asset. So we're going to do the same again this year. And just to remind you that the sale of asset account, its purpose is to calculate whether or not we've made a gain or loss on the disposal of that asset. So remember, with the sale of asset account, the debit side of that account has the cost of the motor vehicle. So I'm just going to put here motor vehicle, and it's the cost of that vehicle. And of course, we know that that's $20,000. Over the other side of the account, we've got the accumulated depreciation of that vehicle. And the accumulated depreciation of that vehicle up until this year, until the date we sold it, was $9,000. And it says here, we sold it for cash, $13,000. Now you remember from year 11, if you sell that for cash, cash at bank will be debited, but the sale of asset account is credited. So I'm going to call this cash received. Now, cash received is sometimes called the proceeds from the sale of that asset, $13,000. So we've now got the three pieces of information we need: what we sold it for, the cost of the motor vehicle, and the accumulated depreciation. So all that's left for us to do now is to work out the gain or loss on sale. So if we look at the two, you notice that the credit side is bigger than the debit side. In other words, we got $9,000 for using the asset. We actually sold it for $13,000. So our benefits, if you like, or our gains, $22,000. It cost us $20,000 to buy, so we found that we've actually made a $2,000 gain on sale of asset. Of $2,000. So when we've done that, both sides of that account actually balance or they equal off. So what's important today is we've got two figures here. The gain on sale of the asset is the accrual figure, so that's going to go in our income statement. But if we're looking at the cash, we actually sold it for $30,000 or $13,000 cash, so that's the figure that goes in my cash budget. Cash budget. Okay, so it's really important that we look at this information in that way. Of course, there could be a second scenario, and the second scenario could be that we might have made a loss on sale of that asset. So what would have happened if we made a loss on the sale? Well, let's just change this for a second. Let's say that instead of selling it for $13,000 cash, we only sold it for $10,000 cash. All right, so if we sold it for $10,000 cash, things will change slightly. Okay. All right, so let's see what happens if we didn't sell it for the full amount. So again, if we were to reconstruct our sale of asset account, which I'm going to abbreviate to sale of asset account, again, let's put the cost on the debit side. So the motor vehicle cost was $20,000 and the accumulated depreciation we said was $9,000, but this time we only sold it for $10,000 cash. So the cash received, or the proceeds from sale, was $10,000. So now what you'll notice is that the $20,000 is the cost, which is more than the benefit we received on the credit side, which is only $19,000. So we've actually made a $1,000 loss on sale of asset. And of course, if you were to do that properly, we would have had $20,000 on the debit side. We've got the $20,000 which we need on the credit side. So that $1,000 loss was worked out by reconstruction. Again, don't forget that the loss on sale goes in the income statement, but this time it's an expense. And the $10,000 goes in the cash budget, but it's considered to be cash received. All right, so there's two scenarios with the sale of asset. Just a quick revision on what happened in year 11. What we also saw in year 11 was you could work out the gain or loss on sale of an asset, and we used a very, very simple calculation in year 11 as the gain or loss equals the proceeds from sale of the asset minus what we call the carrying amount. And it's the carrying amount of the asset, which is really just the cost minus the accumulated depreciation. So we could have done this in a different way. We could have said, okay, well, the proceeds were $10,000 minus the carrying amount. So the carrying amount, as we saw, was the $20,000 minus the $9,000. So the carrying amount, if you like, was $11,000. And so if you work that out, it's the 10 minus the 11. So we made a loss on sale of negative $1,000. So you could do that if you like. You could use the formula to work out the gain or loss on sale. But the account is actually easier because sometimes you're given the loss on sale and you've got to work out the cash figure, how much you sold it for.